Hey everyone, and welcome back to Your Money Your Way, where we break down the big moves in the market. Today, we're diving deep into a name that's been making headlines, Frasers Hospitality Trust, or FHT. Why all the buzz? Well, their majority shareholder is making a big play to take the trust private. Is this a golden opportunity for investors, or a sign of tougher times? Let's unpack it all. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Alright, let's get straight to the heart of it. Frasers Property Limited, FHT's sponsor, along with the TCC Group, has put an offer on the table to buy out all remaining units of Frasers Hospitality Trust at 71 cents per unit in cash. Now, if this sounds familiar, you're not wrong. This is their second attempt. Back in June 2022, they tried with a 70 cents offer, and it just missed the approval mark. This time, they've sweetened the deal by a cent. It might not sound like much, but in the world of REITs, every fraction counts. So, why the renewed push? And what does this 71 cents offer really mean? As of March 2025, FHT's net asset value per unit stood at about 64 cents. The 71 cents offer represents a premium, roughly 1.1 times its book value. This is a key number, and we've seen reports suggesting this multiple is actually better than what we've seen in some other S-REIT privatizations recently. The big question is, why does Frasers Property want to take FHT private now? According to statements from both FHT's manager and Frasers Property, FHT has been facing some pretty strong headwinds. They've pointed to a few key reasons. Structural challenges. The very nature of hospitality trusts, they say, makes them more exposed to volatility. Forex headwinds. FHT has a global portfolio, and depreciating currencies in some of their key markets against the strong Singapore dollar have been a drag on returns. Constrained growth. Factors like inflation, rising interest rates, and geopolitical developments have hampered FHT's ability to significantly grow its distributions, the DPU, and its net asset value. A clean exit. For existing unit holders, the offer is presented as a viable and timely way to realize their investment at a premium, especially given these ongoing challenges. To understand this better, let's quickly look at FHT's recent financial pulse. For the first half of their 2025 financial year, which ended March 31st, gross revenue was 63.8 million Singapore dollars, a tiny 0.9% up year-on-year. But net property income actually dipped by 2.5% to 43.5 million Singapore dollars, mainly due to higher property taxes and utility costs. And critically for REIT investors, the distribution per stapled security, or DPU, fell by 6% to 1.0257 cents. This was due to that lower NPI and, you guessed it, higher finance costs. Looking back at the full financial year 2024, the DPU was 2.2592 cents, which was also a 7.5% drop from the year before. So, there's a clear trend of DPU pressure. Now, what about debt? This is always crucial for REITs. FHT's gearing ratio is around 34.8% as of March 2025. That's pretty stable and well within the regulatory limits. No red flags there. Their interest coverage ratio is 3.0 times, which means their earnings can cover their interest payments 3 times over, a decent buffer. However, the weighted average cost of debt has risen to 3.6% from 3.4% a year earlier, reflecting the higher interest rate environment. They have a weighted average debt maturity of about 2.7 years, and management has stated they are actively working on refinancing upcoming debt. So, what exactly does FHT own? Their portfolio consists of 14 properties, a mix of hotels and serviced residences. These are spread across 9 key cities in Asia, Australia, and Europe. We're talking about assets like the Intercontinental Singapore, Novotel Melbourne on Collins, the Park International London, and ANA Crown Plaza Kobe in Japan. Performance across these regions has been a mixed bag recently. Japan has been a strong performer, with RevPAR at ANA Crown Plaza Kobe jumping significantly. Singapore saw higher occupancy, but average daily rates softened. Australia, similar story, occupancy up, but ADR down. UK showed RevPAR growth driven by better occupancy. A recent positive is the full contribution from Koto no Hako, a retail component at their Kobe property, which should help strengthen income. Their strategy, if they remained listed, would continue to be focused on proactive portfolio reconstitution, meaning selling some assets, buying others, and enhancing existing ones, alongside a commitment to ESG goals. Okay, so the million-dollar question, or rather, the 71 cents question. What does this mean for investors? If you currently hold FHT units, the decision is whether to accept the 71 cents offer. It's a premium to the recent trading prices before the offer really took hold, and it's above the latest reported NAV. Analysts suggest it's a fair exit, especially given the headwinds FHT has outlined. The sponsor group already holds about 61% of the units, and given the narrow failure of the last bid, this one has a higher chance of going through. If it does, you get 71 cents per unit in cash. If you're thinking of buying FHT now, the potential upside is capped around that 71 cents mark, assuming the deal succeeds. If you buy below 71 cents, there's a small potential profit. However, if the deal unexpectedly fails, which seems less likely this time but is always a possibility, the unit price could drop back to levels reflecting its standalone performance and those DPU pressures. The timeline to watch: the crucial scheme meeting for unit holders to vote on the offer is expected around late July 2025. If approved, FHT could be delisted from the Singapore exchange by early September 2025. Looking at the bigger picture, the hospitality sector globally has been on a recovery path, but it's not without its challenges. For smaller trusts like FHT, competing for capital and achieving significant growth can be tough, especially with rising costs and economic uncertainties. This privatization trend isn't unique to FHT. We've seen it across other REIT sectors too, where sponsors see value that the public market might not fully reflect. So, to sum it up for Frasers Hospitality Trust, the 71 cents per unit privatization offer is the defining factor right now. It offers existing unit holders an exit at a premium in the face of ongoing operational and market challenges. While FHT has a portfolio of quality assets, the path to growing DPU has been difficult. What are your thoughts on this offer? Are you an FHT unit holder? What will you be doing? Let me know in the comments below. This is a developing situation, and it'll be interesting to see how it plays out. If you found this breakdown helpful, please give this video a thumbs up, subscribe to Your Money Your Way for more market insights, and hit that notification bell so you don't miss our next update. Thanks for watching, and I'll see you in the next video.